Ant's away today, so I'm going to step in, and first things first, well, I'm not going to say happy anniversary, I'm just going to say anniversary. This day last year, 23rd of June 2016 has gone down in UK history. This is where we had our EU referendum, and the nation, in their wisdom, voted to leave the European Union. And so this is a year on now. It's quite, I don't know, in many ways it doesn't seem like a year ago, but then in many other ways there's so much that's happened since then. I mean, certainly from a political point of view, well, not just here in the UK, of course, if you think about the Trump, the coming of the Donald, but obviously politically here in the UK, we've kind of had about 15 political cycles in kind of 12 months, it seems. So this is the anniversary. I was looking back, actually. Ant did a great kind of post-Brexit briefing that I was looking back at.
And I literally cannot believe what these charts are telling me and what the people of Great Britain have voted for.
So there you go. Can't believe what these charts are telling me, or what Great Britain has just voted for. I'll put this link into the room if you want a reminder. One of Ant's finest deliveries as he reported on the aftermath of that kind of extraordinary day. But if we have a look at markets, this is of course topical. I mean, obviously Brexit's going to be topical every single day. Well, not just up until the moment that the UK leave at the end of March 2019, but I'd say Brexit will be a topical factor every day, I don't know, probably for the next 5 years. And it's certainly topical this morning, because if we're thinking about what's going on in the marketplace, let's check cable here, which has just had a lift to the upside as we've gone through the early hours of the Asian session, and we've just ticked up, and right now we're having a little tester of the high point we had yesterday morning, so just shy of the 123 handle, and indeed, well, sorry, that was yesterday's high, just shy of the 123 handle on the futures. Sorry, I'm showing you the euro dollar, not cable, apologies. I thought that was a funny price. Here's the market I want to show you. So cable breaking above yesterday's high, 127.46 was yesterday's high. That was our clean break of that, and we've had a decent extension. I mean, if we just take this chart out a little further, if I go to, let's say, a 2-hour chart rather than a 60-minute, then you can kind of get this into perspective a little bit, because obviously we've still got some work to do to get back to the kind of point, if I go out a bit further, to get back to the top of the kind of post-election range that we've been in. So actually what's happened this week, we've had a particularly choppy and volatile week for the value of the pound, given the contradictory nature of the communication from the Bank of England, with firstly Carney being very dovish back on the 20th, then Haldane, Bank of England MPC member, being very hawkish the following day, which brought sterling back higher. And now rather than monetary policy driving this extra move up this morning, it's now back to the Brexit scenario, because obviously we've got a 2-day EU summit and we're halfway through it. And so this is the first EU summit not only since the UK election, it's also the first EU summit since King Macron has delivered on his political agenda in France. So what's happened here is Theresa May has, well, she's put the first card on the table, let's say, with regards to this negotiation. And this is, obviously, you know how this is working, right? The first part of this negotiation process is to negotiate the divorce settlement. And there's a few different angles to that. Well, three mainly. The three angles are, right, what happens to all the people, that EU citizens living and working in the UK? And what happens to the UK citizens living and working in the EU? So Theresa May has offered, and here's the chart looking at the nationality of those people those EU citizens living and working in the UK. Let me make that a bit bigger. One sec. This is quite an interesting graphic then, just to give you a clear sense for who are these people. These 2 million, or there's 2.3 million people, EU citizens working here. There's actually upwards of 3 million EU citizens living in the UK, and this is the nationalities of where they come from. Obviously Poland here is a massive standout, top of the list easily. I mean, it's 3 times more Poles living and working in the UK than any other nationality, even Ireland. So you know, that's quite that's not a surprise, I wouldn't say, but it's still quite, you know, you're seeing EU citizens from all over the continent here living and working in the UK. And what Theresa May has offered is that no EU citizen will be kicked out once Britain leave the EU on March 2019. And further, and the kind of big news perhaps, is if you've lived here for more than 5 years, if you're an EU citizen who's lived here for more than 5 years, then you will receive the same rights as a British national. So the same access to healthcare, the same access to schooling and all the rest of it. Okay, so this is quite an interesting card to put on the table. I'd say that's a pretty good offer. And this is Theresa May's kind of effort at trying to just steer the conversation back to a pragmatic approach to dealing with this exit, rather than you know, trying to steer away from the chaos that she herself created when she had a spectacular failure in the UK election. So it's quite an interesting offer. Of course, for this to be accepted, Theresa May is very much saying, look, that's the deal for EU citizens in the UK, but we would expect the same deal for UK citizens in the EU, which total about 1 million. Okay, I'd say this has been quite well received from the EU side, although the Austrian president said, well, all right, yeah, fair enough, on the face of it that looks like a decent offer, but under the bonnet, the finer detail of this, there's much negotiation that will be needed. But I'd say it's a pretty good start. That's probably why you're seeing a little bit of upside for sterling. Not much. If I just go back to that sterling chart, I mean, it's not like dramatic here. We're just ticking up back into the middle of the range that we've been in since the shock election result when Theresa May accidentally lost her majority. So slight sterling upside off the back of this. There's a few other charts I thought on this Bloomberg article that were quite interesting. So of those 2.3 million EU citizens working in the UK, well, what sectors are they working in, or what industries? So manufacturing's number one, over 300,000 EU citizens working here in the manufacturing sector. You've got wholesale and retail, 261,000, healthcare and social work, accommodation and food services, construction here, coming in at 194,000. I would say a lot of the people in this country would probably naively have put construction at the top of the list. Well, certainly when you go back up, certainly when you're looking at the 916,000 Polish people working here in the UK, naively I think we've got a blinkered view on that as a society, and we just kind of make the assumption that they're all here working in the construction industry, which is definitely not the case. Education, and anyway, you can see the rest. So it's quite a well spread mix, but manufacturing's top of the list. If you're thinking about trade, because obviously a big part of this Brexit uncertainty is about, well, what's the trade deal going to be following the exit? And this is looking at the balance of trade as a share of GDP. And so, you know, we've seen that, well, obviously the UK, 45% of UK exports, as we know, get bought by EU countries and EU consumers. And so this is why, you know, ultimately this is a massive risk. If we were, I mean, there's this thing, Theresa May's dropped it now, but she was definitely, the Conservative right wing are definitely all for this idea that no deal's better than a bad deal when it comes to Brexit, which I personally think is probably one of the stupidest comments you could make, and again, naive. And I think no deal would just probably be the world's biggest own goal in the history of mankind. So, but look at this from a tariff point of view, if we had no deal, well, we'd have to flick to the World Trade Organization tariffs. This would be the default tariff situation, and it's actually quite interesting because there's loads of different tariffs for different stuff. Vehicles, 8%. I mean, if we go to a World Trade Organization tariff, 8% on vehicles, and some of the vehicles, it depends on the type, go up to 20% tariffs. This would be a disaster for Germany. German car manufacturers exporting into the UK. Check out cereals here. I don't know why, but 41% tariff is the World Trade Organization default tariff. So any farmer, obviously for the farming industry, this would be particularly bad news. Look at this down here, tanning and dyeing extracts, 8%. This is going to be seriously bad news for Vass and Anthony, who don't mind a bit of fake tan. And dyeing extracts, well, I won't mention who in the Amplify team is dependent on hair dye, but that's going to be particularly expensive for the Amplify staff. So look, this is the tariff setup, the tariff situation. If we scroll down, here's a final kind of chart on this. This is how much money do EU citizens pay into the EU. Oh, sorry, not citizens. How much do EU countries pay into the EU budget? And this is looking at, do you pay in more than you receive? Okay, these are the countries that pay more in than they get back. And obviously it goes in order of size here. Germany, the biggest economy, they pay more in. They've got a deficit of minus 14.3 billion in terms of their contributions to the EU budget relative to how much they get back of that in funding and so on. The UK are the second biggest economy in the EU, and so by nature they're the second biggest deficit. France are the third biggest economy, and so therefore you get the idea. They are the third. They have the third highest deficit. Then it kind of changes here. Italy are actually the fourth biggest, but it's the Dutch that have the fourth biggest deficit. Anyway, you get the point. Obviously, this is one of the big issues that the UK have, or UK people have, with the situation, and that we pay more in than we get back, and blah blah blah. It's not fair, and that kind of thing. So this is that kind of budgetary situation. So anyway, a few just interesting graphics here, just to remind ourselves of what's going on. Just to remind ourselves on the anniversary. Let's have a look at asset performance since the Brexit vote. So 1 year on, how have assets performed? And this is in local currency terms. And as you can see, by and large, it's been pretty good. Certainly, look at this packed end of the left-hand side of the leaderboard here. Equities through the roof. Look, this is all 20% plus stuff. You've got indexes right the way out here to the FTSE 100, even the FTSE MIB, the Bovespa, all of these 20% and higher. Look, Athens, obviously the Greek equities benefiting from the extension to the bailout agreement. But it's been a hugely powerful 12 months. I think this is perhaps misleading in that this isn't necessarily anything to do with Brexit, of course. This is actually more to do with, well, let's just say the post-Donald Trump election situation. But I'm going to show you some charts in a second, because one of the themes of the briefing I want to cover is comparing asset classes. And have we got the situation that equities have diverged from the rest of these asset classes, currencies, commodities, and so on, and bonds? Have equities diverged? And the answer is yes. By the way, just to clear this up, FTSE 100, 20% plus upside since we voted to leave the EU. However, if I scroll down and we have a look at the same set of assets, but now in dollar terms only, so you're removing any FX exchange rate movement now, and the FTSE 100, where are you, is here. So actually, for a US investor, for example, the FTSE 100 is only up 4%. The FTSE 100 is up 4% in the last 12 months. If you're a UK investor, well, the FTSE 100 is up 20% in local currency terms. So, it's definitely all about sterling devaluation. Let's have a quick look. I want to show you on some charts here. Let's have a look at what's happened. I want to look at the long term. I'm not going to use cable for this because I want to remove that kind of Brexit impact. I want to show you let's have a look at 4 charts. And let's take these each in turn. And firstly, let's have a look at the dollar, and I'm going to use euro dollar for this. I'm going to go to a weekly chart. And what I want to just show you is what's happened since, let's say, Donald Trump won the election. And check out what's happened this, you know, in the last 1 month, the euro dollar has ticked sharply higher, and we've had this key break, you know, back above the 110 handle, and here we are trading right up here now, sat above the 112 handle. And I'm just going to draw one line here. I'm going to take that one off. This line I've drawn is the let's say the dollar's value against the euro prior to Trump winning the election. And as you can see, a lot of dollar strength initially off the back of Trumpflation, the idea Trump would deliver on a rapid growth and acceleration in GDP, which would lead to inflation ticking up, which would lead to the Fed hiking, you know, that dollar strength story. But it's all been given back and more. So actually the dollar is now weaker relative to the euro than it was compared to the day Trump got elected. All right. So dollar fully reversed. That's exhibit number 1. Exhibit number 2. Let's have a look at commodities. Let's have a look at crude oil. And obviously here, when we look at this chart, obviously, has Trump had an impact on the price of oil? Well, the answer is really no. But well, I'm just going to say the answer is no for now. But what I wanted to show you is here's the Trump election win. Where are we? Start of November. Here we go. I'm going to draw the line. That's where the price of oil was trading before the election win. Then we had a big rally to the upside. I mean, I know this is mainly due to OPEC production cuts. But anyway, rally to the upside. And obviously the key story of the last few weeks, one of the big stories, of course, is crude oil back in a bear market, dropping more than 20% from its high point that we had back at the start of the year. And what's really interesting and what's very important as we go into the end of the week here is this price point, 42.20. That was the November low. Very important long term. This is on the weekly continuation for the futures. Ultimately the price point below that is below 40 bucks, 39.19, and that was the summer low from last year. Okay, so these are the key technical price points to look out for. But anyway, so exhibit 2, oil back to where it started, back to pre-election prices. Let's have a look at bonds. I'm going to have a look at T-notes here. I'm going to go for a weekly chart again. And not quite so impressive here. So let me draw the line. This is the line T-notes were trading prior to Trump's win, right up at the 130 handle. Massive sell-off. Okay, this is prices dropping and its yields rising. This is all about pricing in that same thing as the dollar, pricing in an acceleration in GDP growth and an uptick in inflation and the Fed having to hike as a result. Okay. Now, over the last 6 months, let's say, off that low point we hit end of last year, we've been grinding back higher. And last week we set a new high on this upside, taking a bit of a breather this week. But if I just showed you, let's just see how much of this Trump win has been retraced. If I just use a Fibonacci. So yeah, we're upwards of 60, well, we're certainly upwards of 50% retraced here with regards to T-notes. Driving back higher. Okay, I'll show you the US yield curve in a minute to finish this argument. But that's bonds 50% retraced. So it's dollar totally retraced, commodities totally retraced, T-notes 50% retraced from the Donald Trump moves. So let's finally look at the asset class of equities, and let's have a look at the S&P, and let's look on a weekly chart. And this is where the divergence comes. If I just draw the same line as I've done on the others, which is where did Trump win the election, was right down here, trading at 2100 on the S&P the day before Trump won, and this thing's just through the roof. This is the divergence. The dollar has retraced all of this. Commodities have retraced all of this. I mean, I haven't shown you gold, actually, just to kind of prove that on the commodity front. Sorry, let me just quickly show you the gold chart. Here's gold pre-election. We tested it 2 weeks ago at 1,300 bucks. Okay, so gold fully retraced, right? So when I say commodities fully retraced, gold is part of that. But here's the S&P just right up at the top. How much does it retrace the Trump move? None of it. So this is the kind of anomaly, I would say, as we move into the second half of 2017. The question's going to be answered here. This divergence can't last. You know, either dollar, or let's say currency traders, bond traders, and commodity traders are all wrong, and equity traders are right, or the majority are right, and equity traders are wrong. And maybe we're in for a little bit of downside here. I've got for the equity markets in the second half of 2017. I've got a couple of slides to show you with regards to something called the yield curve, because we often look at the yield curve when you're thinking about what's a good predictor for a recession. And actually, before I show you this, I got another chart. Let me just find it. This one. How good is the yield curve at predicting a recession? This is looking at, so remember, this is the yield curve here. We're talking about what's the difference between, well, this chart's looking at the difference between really short-term yields, so 3-month in this case of this chart, and longer term, so 10-year. What's the difference between the short end and the long end on the yield curve? And you can see these red bars on this chart, and that they're recessions, and you can see 0 here. And let's take the last 2 recessions. What happened? Well, the yield curve actually flattened and then went negative, so it inverted. All right, that's where actually longer duration yields are lower than shorter duration. It's very unusual, but the last 4, 5, 6, 7, the last 7 times it's happened, we've had a recession. The last 7 times the US yield curve is inverted, we've then had a recession, meaning that it's incredibly good as a lead indicator for predicting a recession. So let's have a look at the US yield curve today. Well, this is the difference between the two, the difference between the short end and the long end, and that difference has been dropping and dropping and dropping. This is a flattening of the yield curve. This is because the Fed are hiking, which is lifting the short end, but inflation expectations have dropped. If I show you a different chart, these are dropping inflation expectations. So inflation expectations have dropped, and we've seen that as US CPI numbers have drifted back lower. And so what you've got is the Fed hiking, lifting the short end, and inflation expectations dropping, suppressing the long end, so the curve flattens, and we're back to the flattest point we've seen in 6 years. It matches the start of 2016, and this is like a 6-year low. And so what we need to monitor in the next couple of months is the US yield curve. Do the Fed carry on being hawkish? Do inflation numbers carry on dropping? Do US data figures carry on disappointing? Does the Trumpflation, you know, the expectation Trump's going to deliver, you know, is the reality going to firmer hit home in that he's not going to? And if all of these, if the answers to these questions are yes, we carry on seeing this, then I would suggest to you equities are too high, and we're going to have to see this thing come back lower. So at the moment, you've definitely got a real weird anomaly in terms of these asset classes. All asset classes have reversed the Trump trade apart from equities, and it's just how long can that last? All right, that's the kind of point I wanted to make. A couple of other slides, charts. We've had some data this morning. French GDP numbers better than expected, so continuing to see this this strong showing from Europe with regards to economic activity in 2017. Here's the French, however, to counter that, here's the French composite PMI number, which did come in at a 5-month low. Their manufacturing print was good, but the services sector number was worse, and so this is maybe the first hint that this stellar performance we've seen from Europe in the first half of this year, just maybe the first hint that perhaps things are beginning to slow. However, when you look at the German manufacturing number, sorry, let me refresh that, that came in a whisker below the May reading, but it's still right up here, as you can see. If I go to a 10-year chart, this is right up at the highest levels we've seen from Germany, going all the way back to the start of 2011. So this is 6+ year highs for this manufacturing PMI reading from Germany, which is a very important reading given Germany's the biggest economy in Europe and given their dependency on manufacturing and exporting. So still pretty decent numbers here from Germany. If we have a quick look at the data calendar for today, then it is services PMI, it's manufacturing and services PMI preliminary readings for June, and we've got the European one about to be announced right now. It's expected on the manufacturing front to be 56.8. So we'll see this number come in now. Later on, I mean, that's it. That wraps up the data for this morning. Later on, we've got some Canadian inflation numbers, some really strong retail sales numbers out of Canada yesterday that saw the Canadian dollar, ramping higher. We got PMI numbers from on the manufacturing side from the US. So this is June preliminary data. We're expecting 53, slight uptick from May. New home sales at 3 o'clock. And then that's it in terms of speakers. We got some Fed guys coming in later around the European close. Okay, so that's the data, and I'll leave you on the news. I don't know if anybody likes tequila. George Clooney does, and he definitely likes it even more now. Here's George. I don't know if you know, he owns a tequila brand, Casamigos, with this guy here, Randy Gerber, who, if you don't know, is actually married to Cindy Crawford. Random fact. Anyway, these two, who've got a holiday home in Mexico, 2013, over probably a few too many tequilas, they had a random idea. I don't know, let's set up our own tequila. Let's start producing our own tequila. And so they did. And they called it Casamigos, and this is their tequila company. Well, that's 2013, right? 4 years later, Diageo have just agreed to buy it for $1 billion. So George is laughing, as indeed is Randy. So that's the best, that's got to be the best story of the week, hasn't it? George making a cool bill from his 4-year-old tequila company. Thanks very much. All right, guys, that's it for the briefing. Enjoy the final day of the week. Have a good weekend.